Is there a bond crisis brewing? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Peter Boockvar, the CIO of Bleakley Financial Group and author of the Boock Report on Substack. Hi, Peter. It's
How are
great.
you?
Good. It's great to have you back on. Hi,
Yeah, great to be here.
PK and Thomas, and everyone who is joining us live on YouTube and Substack. If you are not already a subscriber, please make sure you sign in and subscribe on whatever platform you are listening from. It really helps us out. Oh, Peter. All right. Monday. We're back at Monday. Mixed start to the week. Dow's flat. S&P and NASDAQ had been trending lower into the close. We'll see if they settle there. It seems like everyone is kind of, in wait and see mode. The dollar is down. Bond yields, however, up. Gold up. We have a Fed meeting this week. What do you think Jay Powell and the board are going to do?
So Jay Powell is not in a fun spot. He was not sort of left in a fun spot. So I think that he is sort of flying with a cloudy windshield, just like the rest of us are. And I think he's going to make that clear. I think in the short term, he's waiting, as we all are, to see what the inevitable, or I should say eventual tariff rates are going to be, not just on the countries that we're negotiating with, but also specifically China. So for him to try to make a decision, get sort of ahead of what the tariff landscape is going to look like, I just don't think that that's what he wants to do. And I think that's what he's going to tell us. He's going to be very non-committal. Now, after this meeting, if we start to head to the June meeting and we have deals announced and there's some clarity on China, well, then he can make sort of a more educated guess as to how to calibrate interest rates. But at least for this week's meeting, he's got no clarity whatsoever.
Yeah. And, it's not only tariffs, right? Even with the economic data, it's been a little bit mixed, but we didn't have the collapse in jobs on the monthly number that we thought. We had an ISM reading out today for services. So, it's not like everything's rolling over and they can sort of say, oh, I'm worried about a weak economy. It's been a little mixed there too, at least on some of the headline numbers. What are you seeing when it comes to the data?
Well, it has been mixed. I think the Friday payroll number was somewhat cosmetically deceiving, in the sense that a lot of other data points point to a softening pace of hiring, and even within that payroll number, it got a boost from the birth death model, which is basically a BLS plugin where they estimate the amount of births of businesses and they subtract out the amount of deaths of businesses. And this number typically overstates numbers during inflection points when the economy starts to slow, and does the reverse when the economy comes out of a downturn and starts to pick up steam. It understates. So there was a big contribution from this, like I said, plugin that I think overstated the number. Whereas a couple of days before, the ADP report was about 65,000. Now, the truth probably lies somewhere in the middle, but I do think that overall, the pace of hiring is slowing. We saw that also in the continuing claims data last Thursday, where it rose to the highest level since November 2021. Now, that said, companies are still reluctant to fire people. I still think that after the experience of COVID and the difficulty of bringing workers back, I don't think businesses want to sort of jump the gun with the tariff uncertainty before they know what the landscape looks like. If after that, and we still have 10% tariffs, and we have tariffs on steel and aluminum, and maybe some countries we're going to have high tariff rates, whatever it's going to be, then I think businesses can start making more firmer payroll decisions on the cost side, on the firing side, again. But in the meantime, businesses are calling a timeout on the hiring side.
Yeah, we're sort of, I guess, sort of stuck in wait and see mode. One wonders how long that's going to last. I loved in your report you pulled out, for those of us who are running around and maybe didn't get a chance to see it. In your book report today, you talked about business confidence, and in particular, a story that was in the Wall Street Journal of the CEO of that logistics company who said an asteroid is coming to destroy America's businesses, and it would be extinction level, right? Like wiping out the dinosaurs event, except the dinosaurs are dynamic, healthy businesses. I mean, those were his words. Pretty strong language. And this is an executive who is in a sector where presumably he's talking to a lot of businesses, like his clients are across businesses across the country, as he moves and ships things. What did you make of that? That seems like a really worrying comment.
Yeah, it was from Ryan Peterson, who's the CEO of Flexport, who does a lot of logistics services and management for a variety of different businesses, whether it's booking them shipments or deliveries on train and rail, truck, ocean, and he sees firsthand, the global trade flows back and forth. And when you have essentially a trade embargo on one of your biggest trading partners and the second biggest economy, where so many U.S. businesses rely on, he sees firsthand sort of the dire existential situation that a lot of businesses face. There's one thing to have a tariff fight with China and say, okay, within, call it 6 months, 12 months, these tariffs are going to kick in. I'm giving you a window of opportunity to switch around your supply chains, even though 6 to 12 months is not enough time for many businesses. But to say you have 3 days or a week to make changes, well, that's just impossible. So I hope, and he in the article also talked about being very vocal, going to Washington, D.C., talking to the politicians, talking to people in Congress, explaining to them the dire situation of many businesses if these tariff rates on China are not reduced dramatically and rather quickly. I think June 1st is a really hard deadline point, because I think if you are shipping stuff from there for the holidays, I think a lot of businesses need to get orders in by June 1st. But then the question is, okay, what does the deal look like? What is that tariff rate going to end up being? Is it just going to be ratcheted back to, call it 20%? Well, that causes a lot of strain too. It's obviously nowhere near 145%, but even 20% is going to cause a lot of indigestion for businesses. So I think overall, we're going to be left with a much higher tariff rate than we've seen in a long time. And while maybe we'll see benefits on bringing manufacturing back to the U.S., I'm worried that the tariff implications are going to offset any positives from that.
It's interesting. It makes sense why there would be those concerns. And I think it's like everything, right? It's the degree, it's the fact that it's everyone at once, not country by country with time to adjust and pivot. These are all the things that come up when you ask why people are worried about the consequences. I was at an event with a lot of heads of supply chain earlier this year, last month in March, a month and a half ago. And I was really expecting everyone to be in full panic mode. And one of the things that came up again and again was that they feel battle tested, and that COVID really had people examine their supply chains and their resiliency and redundancy. And yes, you can't anticipate and plan for something like a major, trade disruption like this, but that may be what they learned in their ability to pivot during COVID sort of has set them up a little bit. Are we discounting the nimble nature of businesses and their ability to adapt? Are we too negative on this point, do you think?
Well, you make a great point. And I do think we've seen a lot of supply chain diversification, both from COVID, but also the 2018 tariff war. The problem, though, is that companies that went from China to Vietnam just got a 46% tariff on Vietnam. So there became almost a no-win situation. Well, I diversified my supply chains away from China, and now the companies that I went to are facing a large tariff. Now we have a large trade deficit with Vietnam, but Vietnam has per capita income of about $4,500. I mean, what are we expecting from Vietnam? They're going to start ramping up their purchases of U.S. autos and iPhones when they make $4,500 a year on average,
right?
The median income. So I think that we did shift around. We did create some shock absorbers, but the reciprocal tariffs, even though they've been delayed, we don't know what is going to go back to zero or not. I mean, Vietnam's tariff should go to zero. Well, it's going to probably go to 10%, which was the blanket tariff that we have on all countries. 10% is obviously much better than 46%, but it's a pipe dream to think that we are going to make everything here, vertically integrated, making everything here. It's just I never before are you going to have prosperity with a protectionist type policy, and I think it's just a pipe dream. So
yeah.
I mean, Trump himself told Nike, shift to Vietnam. I mean, the administration in Trump 1.0 told a lot of businesses to diversify from China, and a lot of them did. So I think he made a mistake by then having tariffs on those countries, because you're not making sneakers again here. You're not making socks in the U.S. in a factory. You're not making wire hangers here again.
Yeah, I think that this is what we hear again and again, especially from the investment community, that while the end goal may be, the right one, or may be needed, or may bear fruit or be positive, it's how you get there matters, right? The sequence and the time frame in which these things are happening seems to be what is unnerving, certainly markets. So we talked about the fact that we feel like we're in a waiting period, and everyone is just sort of hanging on the edge of their seat, waiting to get news on a trade deal. Japan and India, a lot of rumors that maybe they might be the first ones. Does it feel like any positive news is going to be able to lift markets and will really help investor confidence, or is this a sell the news type of an event?
Well, I think if we were at the recent lows, I would say it's a buying opportunity. But we've been rallying since the April 9th 90-day delay, culminating with a 9-day in a row winning streak for the S&P. So, in my opinion, we've just had the deal announcement rally, and now you're at a point where when the deals do actually get announced, and they will over the next week or two, they better be good. I think everyone has no idea what a China deal is going to look like. But at least with India and Japan, if the net result is going to be a lowering of trade barriers between the two countries, well, like I said, we may have already had that rally. We're not putting, the genie back in the bottle here. Trump started a trade war with the rest of the world, believing that tariffs are the right tool to get back to this 1950-like belief that we're going to make everything here. And I think that's just unrealistic. And it's more than just China entering the WTO or NAFTA, where Mexico started to take jobs. It's what production efficiency and technology and automation does. Now, are countries not fair with us? Sure. And we can address that, but we're not necessarily fair with other countries too. I mean, Trump announced on Truth Social the 100% tariff on movies coming in from the US. Well, every state in this country is subsidizing Hollywood to try to entice them to bring their production to their state. Georgia and New Jersey, which I live in. I mean, there are tax incentives left and right, which are essentially subsidies. So we all play this game of trying to favor a particular industry or a particular sector. Some people do it more than others, no doubt, and there are barriers that other countries have and others don't. But that's the way it is. Countries have different stages of development. They have different regulatory structures. They have different priorities. So to think that we're all going to have the same level playing field in terms of the rules and the taxes, that's just not realistic. So, going down a path that I'm worried about. I do look at the 2018 tariff fight, and it's certainly on a much smaller scale than we're seeing now. But the end result of that was a manufacturing recession, and the Fed was cutting interest rates in 2019. Did the steel industry get any better off from that tariff fight, or aluminum? I look at the stocks of U.S. Steel and Alcoa, and I can say definitely not. It's now they put tariffs on steel and aluminum. Apparently, it didn't work. So we're just adding more, thinking that this time it's going to work. At the same time, we're nixing a deal with Nippon Steel, the Japanese company that could have invested billions of dollars into the U.S. Steel, which I think that would have made the company much better off than artificially raising some competitor's price overseas.
Yeah. Yeah, that one's been a sticky wicket. Got a couple questions here, and they're good ones, so let's get them in. What J&J asking, what does Peter think happens to DXY, the US dollar, after the trade deals start getting announced?
So, like I said before, I think we've already had sort of a rally in anticipation of the deal. The dollar really hasn't rallied that much, which I think is a tell, because prior to the equity rally, we had dollar down, treasury yields up, stocks down. Now we've had stocks up, treasury yields that are slightly down, but kind of in a range, and the dollar that seemingly can't get out of its own way, particularly against Asian currencies where the Taiwan dollar has ripped higher over the past couple of days. And the Hong Kong Monetary Authority is intervening to stem the rally in the Hong Kong dollar. I think with respect to the dollar, I know we like to talk about it in sort of a homogeneous way about the dollar's either up or down. I try to differentiate the dollar's action against a lot of different currencies, but there's no doubt, at least over the past couple months with this tariff fight, the dollar's been trading sort of together against other currencies, both up and down. I want to think that the dollar is going to continue to weaken here as foreigners pull money outside of the U.S. Between U.S. stocks, U.S. treasuries, and U.S. corporate bonds. Up until a couple months ago, when we've seen a roll down in the markets, foreigners owned about $30 trillion of these assets. And I think there's no doubt that they're pulling this money home. And that is definitely a suppressant to the value of the dollar and I think U.S. assets. I mean, prior to the April sell-off, the early April sell-off, which followed almost a 6% decline in March, the dollar index and the Mag 7 index pretty much followed each other. Last year when the Mag 7 stocks rallied, the dollar rallied. And then this year when the Mag 7 stocks sold off, really beginning late January when the DeepSeek news came out, the dollar index rolled over because foreigners made U.S. stocks a big reserve asset of theirs. And they're clearly saying, okay, we got over our skis here. Our positions got way too heavy, and it's time to sell those stocks to an extent. We don't know to what extent yet. I'm looking forward to the 13 Ds and Fs to come out to update the data, which last they've seen was as of December 31st. So the next batch of data will be as of the end of March. So it'll be pretty timely in terms of flows. But foreigners are realizing that, there are other alternatives now to parking their capital. And I think that's definitely going to flow through in terms of its influence to the dollar. And that matters a lot in this whole tariff debate and where tariffs lay out, because theoretically, one of the goals of the administration, at least initially, was to have 10% increase in tariffs and then incrementally above that, depending on what sector, and then have strengthen the dollar that would then mitigate that cost increase for U.S. importers. Well, that's backfired. We've had the tariffs and a weaker dollar, which is just compounding the cost to U.S. importers and meaning that we're going to pay for these tariffs. It is a tax increase on American business.
One of the things I think is that I've been asking people about and worried about and sensing the worry in the market is that idea that there is now an alternative and that we see countries or large funds, sovereign wealth funds, repatriating some of that money back home. It very much depends on how the speed and order of that, doesn't it? So does it seem like just a reallocation and maybe a correction from an overexposure by any means, by any measure to the US? Or is this something that has the potential to escalate from a trade war to a capital war where their holdings of US dollar assets, particularly treasuries, is something that's part of the negotiation and part of the sort of leverage they feel like they hold over the US? We heard Japan mention that as part of the negotiations. Now, you can argue they're not going to do it. It would hurt them too. That's the argument also with China, right? If they drive the treasury market to the ground, they hold them. It's not great for them. But the fact that it's even verbalized, that was a big deal years ago when they would hold that threat over the US. They haven't talked about it in a long time. Is that a worry? Should we worry about that?
Well, what I think we're going to see initially, and it definitely is a worry, since foreigners own about 30% of U.S. treasuries, though that is down from about 50% 10 years ago. I mean, Japan or China, well, China's been shrinking their holdings for years. I think they were as high as 1.2, 1.3 trillion. Now they're they're down to about 700 billion and change, even though it's probably a bit more than that if there's money parked in Euroclear in Belgium and also another clearing system in Luxembourg. But Japan, all they need to do is just buy less. And to your point, they did use it as a threat because we still rely on foreign flows into U.S. Treasuries. And one of the dangers of shrinking your trade deficit is you also shrink your capital account surplus, which means less money coming into the U.S. Now, in terms of the dollar being a reserve asset, as a percentage of that reserve pie, the central bank reserve pie, it's been shrinking for decades. 20 years ago or 25 years ago, the dollar made up about 70% of central bank reserves. Now it's down to about 58%. Now, on the flip side, in the dollar as a source of foreign exchange transactions, it's still almost 90%. So it still holds sort of a high market share. But you're beginning to see, of course, China wanting to trade more in in their own currency for certain crucial commodities that they need, whether it's oil from Saudi Arabia or Russia or soybeans from Brazil. They're choosing to transact in their own currency rather than dollars. I think the dollar is still going to be a dominant currency, but if it becomes just less so, then that matters. And that's why that's why gold essentially is at a record high versus the dollar. So the dollar has dramatically devalued against the price of gold. And I think that is noteworthy instead of just only looking at the dollar's action against the euro, the yen, the pound, Canadian dollar, Swissy, or whatever.
Yeah. What's your sense on, someone just said you're always great on China. We know you've been watching it. We know that's been on your radar for a long time, and where you saw opportunity at some point. How much does China need a trade deal done as well? There's a lot of blustering, right, and positioning around this, and they'll fight to the end, they say. The U.S. and China both seem really dug in, but how much do they need this trade deal versus the U.S.? Who do you see as having leverage, and what's happening with their economy?
Well, I think we both need a trade deal done. That's where it's gotten to. It's like, oh, you're hurting more than I am, so I have leverage over you, and vice versa. I mean, it's like we're back as 7-year-olds in the playground here, as of who can punch the other person harder, and give them a little black and blue mark on their arm. I think both countries suffer from this. The one difference, though, is I think politically and sort of optically, China can withstand more than we can. President Xi doesn't have an election that he has to think about. Xi knows that if he drags this out another month, Trump is going to have to deal with empty shelves. If he drags this on for another 2 months, Trump is going to have to deal with empty shelves of toys come this holiday. So China can drag this out. They're going to take a lot of pain, no doubt. I think there's like 12, 13 million manufacturing workers that are going to suffer from this. But they can deal with that political pain where I don't think we can here. So I think there's a level of arrogance sort of on both sides that, oh, I can outlast you, but politically, China can outlast us because no politician, like I said, wants to preside over empty shelves for their kids.
Yeah. No, it's a very dangerous game, and I think it's that concern that it keeps rippling through the markets. Even when we've been seeing this rallied 9 days, it's not felt great, right? Because we're still digging out of the hole, and there just seems to be a lot of uncertainty. By the way, for everyone who's joining on Substack, I'm going to catch up with Gio Chen. I'm going to do a live on Substack at 9 a.m. tomorrow. Mark your calendar. He runs a family office over in Singapore, obviously very across what's happening in Asia and, of course, U.S. markets. I'm very curious to hear what he has to say and his view on this and thoughts about the dollar and all things related to that. So be sure to join us for that. So, this brings us to Treasury. Someone was asking, Ched was asking, keen to hear Peter's view on bonds. Will we really see 5%? We know the stock market sold off, but it seemed to be the move in bonds that really caught the administration's attention and, caused them to respond. What are you expecting for the bond market and for bond rates here, treasury yield rates here, Peter?
So I do think we're going to see another retest of 5% in the 10-year. I mean, I think we're in a bond bear market that has many years to run. I say many years because if you look at the history of interest rate cycles, they tend to last 10, 15, 20 years. And we're just a few years into this post 40-year bull market cycle. So I do think that there's going to be upward trend in inflation in the longer run. Obviously, the Fed is going to influence what they can do with the shorter end, particularly the 2-year, which is very much tied to the Fed funds rate. So, even with the possibility of a recession, I know there's a big debate now on whether the tariff war is going to be able to sort of create that the 10-year yield is still around this 4.30 level and not below 4%, I think is an interesting tell. Of course, the debate about tariffs and its inflation flow through, is it a one-time step up in price, or is it something that can be longer lasting? We'll have to see, of course. I think that the muck up in the supply chains are going to cause, a multi-year increase in prices. But, it's funny because some people think that, okay, it's just a one-time step up in price, therefore everything is fine. Well, if prices step up by 10, 15%, am I supposed to feel better as opposed to like a multi-year time frame where it goes up 3-4% a year, even though the end result is still the same? So, a lot of companies want to pass this on, their increase in input costs. Not everyone can. Some of it's going to have to be eaten. But if a lot of it has to be eaten, that doesn't mean that inflation has magically gone away because it doesn't flow through to the consumer side. U.S. businesses and consumers are going to eat these tariffs. It's just a matter of where along the supply chain it takes place.
Yeah. This comes back to the execution, right? It's very hard to work around that when so much, everything's impacted at once, right? It's like everything you think about buying, if you just think of your daily life, has the potential to go up and or not be available. It's not like you can say, okay, I'm going to try to buy from somewhere else. I mean, we've all seen the stories of people going around trying to find something made in the US and it's non-existent. So it's a very big hit very quickly across a very wide range of goods. So that always has me a little puzzled how that's not going to create a massive shock. I just haven't been able to wrap my head around that. A couple questions coming through on from the chat. What are you thinking about Mag 7 CapEx spend? And nobody does deep dives into all these earning calls like you, Peter. What were you hearing? What is your take on that? And Paul, I think it's related. Is the AI narrative still holding strong?
So if you look at Meta, they actually raised slightly their 2025 CapEx spend figure to sort of like the mid 60 billion level. Microsoft, Google, and Amazon sort of kept it where it is. But on a sequential basis, the growth rates relative to last year, I think they're going to start to slow. They're still going to be robust, but in terms of the where we go from here. But keep in mind, the market has sort of switched its focus to all this CapEx spend being a drag on earnings. It's a lot of this expense is capitalized and it's showing up through higher depreciation expenses. So all this spend, while maybe it ends up being just fine in terms of how these companies are able to monetize it, the extraordinary spend has made these businesses more capital intensive rather than prior to this, the tremendous cash gushers that they've been. So it definitely changes the business model to an extent in terms of on a free cash flow basis. And I think at the end of the day, they deserve probably lower multiples as a result. Now, the beneficiaries of that spend, well, at least from the perspective of NVIDIA or Dell or Hewlett Packard enterprises that are selling into all this spend, they'll still continue to benefit. But, there's going to be a point in I think, probably in the back half of this year and into early next year, where these companies are going to decelerate the pace of the spend. Also, keep in mind that this is not an autopilot type situation. If the economy rolls over, if we go into recession, and Nadella at Microsoft specifically said it, they can ratchet back their capital spending in response to any economic downturn. So there's nothing autopilot related here. And at the end of the day, Microsoft is still sensitive to higher employment, particularly through their Microsoft 365 seats. You need more hiring to sell more sort of seats. Amazon is still very much reliant on retail. Google and Meta are still very much reliant on advertising. So we're all in the same sort of economic boat together, that they're sort of maneuvering those waters as well. And I do think if those waters get further choppier from here, that could impact how much they spend outside of what they told us last week on their earnings calls.
Yeah. And it's so interesting because we've been talking about this. We've been talking about the supply chain, talking about, prices, talking about shelves, but we're in this grace period where everyone built up inventories. So it hasn't hit yet. If we that's why I think everyone's kind of bracing, because it's coming, but it's so hard to anticipate what that's actually going to mean and due to confidence when it happens. So Mr. Mustang Man was like, should I buy tires now or wait? I mean, we're all doing those calculuses. Like, should we go out and stock up? What do you like here, Peter? It sounds like you're very worried about a lot of things, and there's a lot of uncertainty, and the trend is negative for a lot of these markets. What do you like here?
So I'm still very bullish on precious metals and other commodities. I've been bullish on oil and gas stocks. Obviously, oil's broken below 60, but interestingly, the stocks have actually hung in pretty well. Natural gas, I prefer much more. We're long EQT, and that's been a pretty strong stock. I still like agriculture. I think the market, and something we've talked about in the past this year, is the market to me is transitioning away from that old playbook, that old Mag 7 big cap tech playbook, and the investors are finding other things to buy. And I think the need to have your hands on important raw materials in this now growing multipolar world is more and more important. And I think international stocks on a multi-year basis are going to play a lot of catch up to the extreme U.S. outperformance over the past 10 to 20 years. So we like stocks that trade in Europe. We like stocks that trade in Asia. I think that's where you're going to find the best opportunities, both from a valuation perspective, a potentially weaker dollar perspective, and also looking at countries that are going to be more sort of immune to this trade war. I mean, there's this belief that the U.S. is somehow going to manage through the best in the tariff war that we started. And I think I'm afraid it could be the opposite.
That's a big statement. I got to ask you about Europe. Just a note, though, because we brought that up. Commodities. I mean, we hear this all the time about this being sort of a different environment now, and this idea that hard assets are going to have to be a bigger part of all of our portfolios. I think is something we're going to have to wrap our head around. Do you tend to like the equity as opposed to the metal, or it just kind of depend, or opposed to the sort of commodity, or it just depends?
Well, in precious metals, I prefer the physical, but we do own some of the individual miners. With fertilizer, oil and gas, uranium, we like some of the companies that are involved. Now, uranium, you can buy a physical, which we do own some of that, and also platinum, we're also bullish on, and we don't own physical there. So it really depends. I mean, with platinum, the three biggest producers of platinum are Russia, Zimbabwe, and South Africa. You're not buying a stock in Russia right now. And with respect to Zimbabwe, probably not either. There are some choices in South Africa, but that's a particular situation where I prefer to own the metal itself rather than a company that's producing it.
Yeah, this is where we all got to do a lot more homework. By the way, we always drop Peter's information into the description. We're also going to put another link too for anybody who's looking to do a little bit of a deeper dive on gold and silver, because it's been coming up so much. If you want to look at increasing your exposure to metals, we're going to put a link for Hard Assets Alliance. It's a platform with over 3 billion in assets. We'll drop the link in the chat as well as the description. Just note that it's an affiliate link, so we may earn a small commission if you click through and open an account. Peter, you mentioned Europe. This is such an interesting, because I think people hear that and they think, well, yeah, from a valuation perspective, it's understandable, and we're all looking at it and what's the best way to do it. But then you'll hear people say they have, how can Europe lead again? They have completely mucked up their energy policy. They don't have political unity. They have, the demographics are terrible. There's some other structural problems with that. Just as an example, you could say the same for other places as well. And that energy demographic combo, bureaucracy, anti-innovation. Again, this is what the alternate. I'm not saying this. It's just what some folks will say who are bearish Europe. So they don't see that coming true. Is this just a valuation? Do you have to be careful to not make a complete leap out of US when we're talking about increasing exposure? How should people think about some of those shorter term opportunities, but some maybe longer term structural issues?
Well, I think it's important to understand that a lot of companies in Europe are big multinationals like we see in the US. But because of where they're domiciled, they tend to trade at a lower discount. Take BP and Shell, for example, putting aside the price of oil, which has obviously come down a lot. BP and Shell have a much lower valuation compared to Exxon and Chevron. Now, part of that is they've sort of went off the rails a bit on their renewable focus, but they've dramatically pulled that in. But they're trading at a discount because they're domiciled there instead of the U.S. One of the stocks we own is Veolia Environment, that is one of the largest solid waste companies in Europe, but they have a big water business throughout the world, energy business throughout the world. But just because it's domiciled in Paris, it trades at 15 times earnings instead of north of 20, where you would find Republic Services or Waste Management in the US. Nestle is the largest food company in the world, and it's domiciled in Switzerland. But because of that, it trades at 16 times earnings, 17 times earnings, where in the US maybe it would trade 20 times earnings. So I think that's sort of one of the reasons for that discount. But there are a lot of attractively priced, good dividend paying companies. And one thing about Europe is Europe tends to pay higher dividends than the US. I mean, the dividend yield in the S&P 500 is like 1.2% or 1.3%. Where in Europe, you invest in the UK, and the dividend yield, because of a heavy exposure to commodities and financials, you can get 4 to 5% type dividend yields. And I think in this kind of environment, I think total return, where dividends are going to join protect potential earnings growth, dividends are going to be a big help to overall returns going forward from here.
That's a great point on dividends. And it's not something we talk about very much because, again, we've been in this environment of, 25% gains on things like, or 180% in 1 year on NVIDIA. So we've got away from thinking about things like dividends, but it's such an important part of the conversation. Peter, we always appreciate when you catch up with us. I know you're a little bit under the weather. You would have never known. You powered through as usual. And we so appreciate that.
Thanks, Maggie. I appreciate having me on, and I will always power through any cold that I have for you.
Thank you so much, and feel better. We'll catch up with you again soon. Thanks for all the fantastic questions from everyone. Appreciate you all joining live. And Matt, I see your comment on Substack. Thank you for that. Let's squeeze one more in since it's coming from Substack. Peter, bear with us for a second. Brent Johnson came out today with a very negative article about capital flows, with China collapsing first, which will cause a huge repatriation of funds out of non-China markets. China collapse, does that seem a little exaggerated, or is that something
it's hyperbolic? I mean, there's no doubt there's stress, but to say that a $17 trillion economy with 1.4 billion people is going to collapse in certain areas of manufacturing that sell to the U.S., there's major risk there for sure. But the U.S. is 3% of the Chinese economy. So, you can collapse that 3%, but there's still a broader economy. But China repatriating their money from the U.S., we basically told them to. We told them to take their money back. But you know what? They're going to do it, and U.S. assets are going to go down as a result.
Right. Watch what you wish for. Malky, we will we'll drop a link in. We're going to repost this tomorrow on Substack. He's asking for your info, Peter, but you can also find Peter's Substack, the Boock Report, and search for that and locate him there. So appreciate you all joining. Peter, thank you so much. Take care. We'll see you again soon. And everybody out there, take care and good luck. We'll talk soon.